Hello and welcome to Rebel Finance School. It is a very special bonus week. It's the Investor Policy Statement Workshop.
You've done Rebel Finance School, you've been building your Freedom Fund. But what happens when the market crashes 50%? What do you do when the headlines scream, "This time is different"? And your emotions say, "Sell everything." What do you do?
What do you do? Do you panic? Do you freeze? Or do you reach for your investor policy statement? Your rock in the storm, your anchor in the chaos, your guide where everything feels uncertain.
Today, we're going to help you build that rock. Your IPS, your investor policy statement, is your emotional safety net. It's the plan you follow when your brain's screaming and your heart's racing. It's your way forward no matter what the market does.
And in the words of the Mandalorian, this is the way.
And we're not doing this alone. We've brought on today one of the kindest, wisest, most generous humans in the financial independence world.
We met him at Chautauqua, then at Economy, and we've seen him all around the world. He reached financial independence, and instead of sailing off into the sunset and just fishing all the time, he volunteers his time to help others win at the finance game too.
He gives his time? He doesn't have to. He's awesome. He's the calm in the storm. He's the voice of reason. Please give a massive welcome to Mr. Bob Haines.
Hi all.
Hey Bob, thanks for joining us. And stick with us right to the end. You will walk away with your own investor policy statement, a clear drawdown strategy, the confidence to stay the course no matter what. Because when the market wobbles and emotions run high, this is the way. So we're very excited to have you here, Bob. Thank you for joining us. This is going to be a lot of fun.
Because
Thank you for having me.
Yeah, it's going to be awesome. So we worked with Bob to design this workshop so that you're actually going to be doing some work tonight, people. You're actually going to be writing your statement as we go today. So you are going to leave today with your very own investor policy statement. Woo! And you're like, hang on, Katie, Alan, Bob, what's an investor policy statement? What's going on? What is this?
Why do I even need an investor policy statement? What the heck is one? Bob, what is an investor policy statement and why do we need one?
An investor policy statement is a written plan that you have that you can refer to make sure that you're staying on track and following your goals, your asset allocation, and your philosophy when times are tough. You know, I know that I should not follow the daily market movements, yet I have a bad habit of doing so. So whenever I get a little bit excited about something going wrong or something going really right, like maybe we should put a bunch of money into AI, for example, I just need to refer back to my investor policy statement and say, no, it doesn't say that in there, so I'm going to stay the course.
And how often do you get tempted, Bob?
Oh, I tend to get tempted very often. Unless I'm really busy doing other things, I am, my wife says I always see squirrels run by and tend to go chase the squirrel. So my wife is the one that's, always referring me back to the investor policy statement.
So should you be doing this as a couple? Should you be doing this as a team? Like, is there a benefit to do it together?
Yeah, I think designing it together to make sure that you're both on the same page, you have the same set of goals, the same philosophy on, and agree on, the way forward in your investing life and what you want for your big why. And then it just really helps, especially if you have one in the couple that's chasing squirrels like I often do.
Because this is not just like I love geeking out and doing things like this, but this is not having it for its own sake, right? This is like helping you to lead the life that you want to live and guiding you and keeping you on track. Is that right, Bob?
Yeah, that's it. I mean, you want to have some really big picture goals that you're going to have delineated out in your investor policy statement. And then all of the other sections are really to help you support those goals and your why of five.
I love it.
I love that. David on Zoom says, I didn't sign up to do any work.
Well, David, I'm sorry, you're here now. So get cracking.
Tuck in. And also Robin on YouTube says, funny story, I just rescued a baby squirrel, which is hilarious that she did that today. Well done, Robin.
And Abs to put about 10 squirrel emojis in the chat as well.
So do you do this individually or with your partner. Like if you have someone else in your life, maybe the family, maybe the team, it's actually really important to do it together so you're both on the same page about where you are going. And this is all about your vision for life.
Yeah. I already said that bit.
Okay.
I didn't feel the need to add to it there.
Good. Now, for those of you who have just shown up for tonight, this does build on Rebel Finance School. So if you haven't watched Rebel Finance School, like we will say some stuff that you are probably not going to understand. So it does build on the workshops we've already done. And as always, we have a disclaimer. This is not financial advice. We are not regulated, even Bob. We're not trained financial advisors, even Bob. We're never going to try and sell you any investments, even Bob. You make your own decisions, sharing our own opinion and ideas. These ideas may or may not continue to work for us, or even Bob. You are 100% responsible for your financial future. There are no guarantees here, except the money back guarantee. If you don't like the course, you can have a full refund. Please speak to Bob afterwards. Investments can and will go up and down. So what goes in your investor policy statement? There's kind of 5 sections. And the 5 sections are, number 1, your goals, your investment goals. Where are you heading?
Then we're going to talk about your investment philosophy, and we're going to guide you through each of the sections as we go.
Then we've got your asset allocation. What are you actually investing in?
How are you going to live off your money when it comes to the time of doing so?
And then when do you rebalance? How do you rebalance this stuff?
And as we go through this, there's kind of 2 different stages of life or finances that will dictate what you're putting in your investor policy statement. So as we go through, we're going to say, well, this is for the freedom fund builders. So those of you that are still working towards having your full freedom fund to be able to live off it, and those of you that are financially free or thereabouts.
Yeah, this is obviously what financially free looks like to us, eating pizza and having Lego. But you can have your own version of what financially free looks like.
Also, the fact there's a full pizza and a slice in my hand means there's like a second pizza somewhere in the background.
And that's what it's like being financially free. Right. Remember, this is your first iteration, so it will not be perfect.
I do have a question. Are there any perfectionists out there? Put P in the chat if you're a perfectionist. Tell me. Have we got any perfectionists listening? Oh, a bunch of P's.
Julie nodded at that point. She said, yes, that's me.
Any overthinkers in the house? Put an O if you're an overthinker, or PO if you're a perfectionist and an overthinker. Yeah, a bunch of POs. Yeah, I see you. I see you out there. This is the first version, okay? It's not going to be perfect. There's going to be bits where you're like, I don't know what to put. Like, just go with your instinct, with your first guess. You can always come back to this. This workshop's going to be staying up forevermore. You can come back and review it and update and refine. Let's just get a really good, solid version 1, and then you can come back and change it whenever you want.
Perfect. Penguin on YouTube says PO times 10. So I think this was designed for you. We'll just relax through this. Right, let's get straight into the first section, which is goals. And also my favorite image of the night. I fed AI a picture of Bob and told it to create Bob scoring a goal. So this is what Bob looks like as a Premiership striker. We also have renamed him as Bob Messi or Lionel Haines. I think that's exactly what he looks like. Now, goals. The idea here is you kind of put in where you're heading in your different goals. So you might have goals like build my freedom fund to X pounds or X dollars by date, whatever it is. And we put a date there because the date kind of turns it from a wish to something that you're actually working to make happen on a date.
Maybe it's something like growing your emergency fund to get that full emergency fund in place so that you're ready to go full steam on investing. Again, a certain amount by a certain date.
Or pay off all non-mortgage debt by X date. Purchase a home with X deposit. Retire early by, or grow my kids' grandkids' education fund. Whatever it is your goal is. Now, we have to highlight there's 2 main types of goals here. There's savings goals and investing goals. And the investor policy statement is about your investing goals. So we kind of want to separate those out a little bit. So on the savings goals side, you have pay off all the high interest rate debt, grow my emergency fund, purchase the home, take the grandkids to Euro Disney, whatever it is.
And then on the investing goals, it's things like maybe it's invest my first £1,000 or dollars into a global index fund, or build my freedom fund to X pounds by whatever date. And that can be somewhere along the way as well, right? Like, it doesn't have to be the full freedom fund. Maybe you're working towards your first 50,000, 100,000.
Yeah, might be retire early by date X, create a retirement where I have X to live off a year, whatever your version of this is. And the investor policy statement is primarily about your investment goals. And we just thought we'd give you a version of ours, like what were our goals along the way. Our very first goal when we found out about money was like, how do we even buy an asset? Like, it took us 2 years to figure out how to buy an asset. And that was like our sole goal, was buy an asset. And we were wandering around going, where's the asset shop? And it took us about 2 years to find it. So that was our first goal.
Then our second goal was to get our first £100,000 invested. And that was, we set that smaller target along the way.
And then like our third goal was the full thing. We want to have £1 million invested so that we can live off 4%, 40 grand a year. That was our goals.
And then if you're kind of already there or thereabouts with your full freedom fund, perhaps you have some freedom funds goals. So my freedom fund allows me to travel the world full time without having to worry about working for money, something like that. What's yours, Bob? How would you fill in the rest of this sentence? My freedom fund allows me to...
My freedom fund allows me to travel the world with my wife, fish with my dad 2 to 3 days a week, volunteer my time and energy helping other people. I can't tell you how incredible it is to be financially free and then be able to just design your life the way that you want it to be. So the sky is the limit here. Obviously, we put some examples, but everybody's life is different, and maybe your goal is to just go work half time instead of working full time. Maybe it's to retire your wife so she can stay at home with the kids. Whatever it is, there's no wrong answer. It's whatever's right for you.
I love that. And the whole purpose of this is for you to have these goals front in mind to help you know where you're going for, because money is a tool to create the life you want to live. Money for money's sake is not the goal. Money is the tool to help you live what you actually want to live. So in a second, we are going to turn it over to you and tell you all about the goals. So that's what we're going to do, is we're going to turn it over to you. We're going to ask you to write down your top 1, 2, or 3 investing goals. But we have a cool tool for you.
A cool tool.
A cool tool. So I have been creating this week, and I have built, you can do it on paper or you can use our tool. We have created an investor policy statement tool. So if you scan the QR code, it will take you to a Google form where you can just like type in your answers. And if you put your email address, it will then email you the investor policy statement back. So I built this over the last few days for you to be able to use. It's just a simple Google form. Fill out each individual section. It then pulls it all together for you and then emails it back as a PDF.
If you're watching on Catch Up, you can either scan the QR code or the link's in the YouTube description.
Yes. And it also has a few extra comments from the Donegans when you get it back as well, obviously.
So please load that now, because we're going to get you to fill in that first section. Please, please, please double check that you put your correct email address in, no typos, triple check that, because if there is a typo, the fairies won't be able to send you your investor policy statement when it's complete. So please double check that.
Exactly. We had a question in from Mark, says, does the form keep the data anywhere? The form feeds the data into a Google Sheet, which then turns it into a PDF and emails it back to you. I don't really want your data, but I had no other way to do it. So I promise you, I'm not going to do anything with it whatsoever. And then we'll just delete it after a while. So there you go. That's what happens to the data. Bob, Bill asks a question. What's the difference between an investor policy statement and a comprehensive financial plan?
Ooh, that's a really interesting question. Um, I guess a comprehensive financial plan. First of all, I think like the question might be a little bit above my pay grade, but I will answer it to the best of my ability. I would think a comprehensive financial plan would be something that maybe somebody like a certified financial planner or a chartered financial analyst, somebody with a lot of those letters after their name that has a lot of specific training on this would put together for you. And it probably is much broader and more detailed in nature. The investor policy statement I see as a really cool, 1 or 2 page tool that allows you to define where you want to go and how you're going to get there. And then you can leverage that tool to make sure you stay on the path when things get really shaky in the market, or just when you have big picture questions. Someone might have maybe an inheritance and they got 100K. You'll see Facebook groups filled with things like, hey, I got a 10K inheritance or a 50K inheritance. What should I do with it? How should I invest it? And if you have an investor policy statement, you can simply refer to your investor policy statement that says, oh, I should put it in 100%, FTSE globally diversified fund. So I'll just go ahead and put the 100 grand there because time in the market beats timing the market. And so it allows you to answer a lot of questions that will come up in your life around your money and your investments very quickly and very easily.
I love that. That's fantastic. So please, as you do this, please tell us if you've done this section. Have you found the form? Have you written in your goals? Have you got some ideas? Ask us questions, because we kind of need to know from you, have you done it, to make sure we keep the workshop moving. So please tell us in the chats. I'm looking up because the chat's on the big screen in front of us.
We're going to take you through each question as we go. So please just stick and do the goals one, because we're going to explain what the other sections mean as we go.
Exactly. Okay, Monique's still going. Kate's doing it now. Sarah's done it. Paul Reynolds on YouTube has done it. Sonia's doing it. So we're moving along nicely. Bob, how did your goals change over the years?
Yeah, that's an interesting question. So we didn't actually have our investor policy statement until we were actually financially free. So I didn't find the tool until late. But certainly we did have goals that were intermediate along the way. I think early on, Amy and I was really fortunate to meet my wife where we were kind of like on parallel financial independence journeys before we even met each other, which was fantastic. We had things like, in our career wanting to max out the company match, and then even further than that, maybe maxing out our 401ks, so putting in the annual limit in there. And then we had things like, well, then what do we do with excess money? So maybe we invest an extra $10,000 in a taxable brokerage account or something like that. I also had a very vague notion when I was younger that I wanted to retire early. So that was kind of something that was in my mind, what I wanted to do. But for a while, I didn't really have the wherewithal to figure out what that was until I found this community. So, yeah.
I love that. So Bob kind of set out like his goals, just to translate American to the British audience. It was like maxing out my SIP contributions or maxing out my ISA allowances. So I make sure my money is tax-free and protected, which can be a fantastic goal to have. Okay, so I think we all know there's a few people saying done in the chat, which is fantastic. If you're not done, it's okay. You can use this tool as many times as you want to do the next version. We're going to move on to the next section.
And if you're watching on catch up, clearly you can just hit pause, take as long as you want, and yeah.
You mean they have the power to pause us?
They could spend 2-3 hours doing this if they wanted to.
I don't like that people have the power to pause us.
They can 2x us, they can half x us.
I love it. Okay, so there's the go. Josie says it's good to agree your goals with your partner. Yes, absolutely agree. You can do this as a team, which is fantastic. Okay, so we've had a quick look at goals. We're now going to move on to philosophy. And you might be thinking, like, what are you talking about, philosophy, Alan? We don't do philosophy here, but it's your investing philosophy. Now, Bob, this was one of your favorite statements. Do you want to read it out for everyone and tell us why you thought about it?
Yes. So this is a quote from J.L. Collins from his book, The Simple Path to Wealth. And he says, everyone makes money when the market is rising. But what determines whether it will make you wealthy or leave you bleeding on the side of the road is what you do during the times when the market is collapsing. So I think that, we had a very real world example back in 2022 when the market was down double digits. The stock market was down double digits here in the States, as was the bond market. And, when you see a large percentage of your freedom fund disappear in, a matter of weeks and months, it becomes very easy to say, well, maybe I'm not doing the right thing. Maybe I need to change my asset allocation. Maybe I'm doing something wrong. I need to hold on to more cash or, sell something. And J.L. Collins rightly points out that you actually have to stay the course. You have to stay the course instead of don't just do something. Instead of don't just stand there, do something. It's don't just do something, stand there. That's exactly what you want to do, is absolutely nothing. And that's what the investor policy statement helps you to do.
Which is exactly the opposite of what I've trained myself into do in life, which is to not just stand there, to do something to make it better, which is like why it's so confusing when it comes to investing. It's like, don't mess with it, fight your instincts and do nothing.
We're kind of solidifying what we've been talking about throughout the course. Like if you leave your money invested over the long term, chances are you'll be fabulously wealthy. All these sorts of things of timing the market is better than timing the market. All the kind of ways of thinking about investing that we've talked about throughout Rebel Finance School.
So when we're talking about philosophy, there are probably a couple of little differences between the people who are building their freedom fund and the people who are living off it. But kind of to give you an idea, you've got, I invest in low-cost global index funds. Like a nice simple statement of what you do. It might even be more specific, such as I invest in the
That's the next one.
Oh, okay, good.
That's the next bit.
Thank you. I accept average market returns. Well, that's actually a hard one for some people to do because they're like, try and do things to optimize. But no, I accept the average that the market gives me. Time in the market is more important than the market.
And then for people that are financially free, actually, it's very similar, if not the same. I invest in low-cost global index funds. I accept average market returns. Time in the market is more important than timing the market because, as you remember, you're not investing until you retire or until you're financially free. You're investing until you
expire.
So actually, feel free to tweak this. We've got some suggestions in that tool for you. But whether you're building or you're financially free, it's very similar if you're following the Rebel Finance School philosophy.
And you'll see in the tool, it's got a couple of check boxes. So you can choose the ones that we re-put in, or you can add in your own ones under the other bit. So I added in the market always goes up over time for my version to remind me just to chill, because over time, it'll always go up. Highland Horatio is like, I've done this section. Come on, Donegans. Paul Wright has done his as well.
Constance says, is there any information on when to rebalance as a philosophy? We've got rebalancing
as a further section. Yeah, so we'll come on to that. Bob, what's in your philosophy section?
So yeah, let me look. I literally refer to this all the time, but I can't tell you what it says. I have to look at it. So mine says, invested in a diversified portfolio of low-cost index funds, keeping expenses low, accept market returns. I have rebalancing in here, but we'll catch on that later. And I had been saying until I took Rebel Finance School risk tolerance, but now I say volatility tolerance is moderately high. So that's kind of my philosophy. And I think, that whole bit about accepting average returns is tough, especially for people that are used to like competition and always want to win, right? It's like, why would I accept the average returns? And when you realize that in financial terms, the average returns actually mean that over a long enough period of time, say 20 years, you virtually beat every single professional money manager that works on Wall Street. So by just accepting the average returns, you will have the most above average result over the long period of time.
Yeah, which is almost hard to wrap your head round, is I get better results by doing nothing. And that's always the piece. Katie, did you spot a question we needed to answer?
I had two.
Okay, well, let's start with one.
So Di says, this might sound a bit doom and gloom, but when I hear time in the market, a little voice goes, yeah, but what if I need the money earlier? I think because I've sadly lost a few friends of late to terminal illnesses. I know that pensions can be accessed in those situations if you do have a terminal illness. But what about other investments? So she's saying, well, yeah, I understand leaving it in for the long term, but what if I do need to access it before that for some reason?
Well, it's still there. If you lock it up in a SIP, you are locking it up until the date that you can get to it. But your money is still there. The SIP has certain rules that you can get it out if you do have terminal illnesses and different things, which I do not know enough about to be quoted. But an ISA you can access at any point. So the money is still there. And that's the key point.
Sonia says,
I think I would just add, sorry, but just to add a little piece to that, I would also go back to a distinction between savings goals and investing goals. So make sure that you have, an emergency fund that's all topped up. And if you're saving for something like a down payment for a house, there's a couple different philosophies. It's like, well, if you definitely need to buy a house in the quickest amount of time, then you want to make sure that you're using a savings vehicle that maybe pays a higher interest rate, but not invest it. If you say, on the other hand, like, hey, it's okay if I buy a house in 5 years, or if the market goes down, it's okay if it's in 7 or 10 years, then you can go ahead and invest that money. So it's important to have that distinction between the savings and investing goals.
Absolutely love that.
We have a question from Sonia saying, I've worked in early years in the USA and have a 401k too. Will you and Alan and Katie do a USA version? Sonia, do you mean of the investor policy statement? If so, like, this is designed to be global as possible. This is kind of the ways of thinking about it, and you can put your kind of USA specific stuff in the form as we go along. Is that what you meant? She's
okay.
Okay,
she said okay, cool.
Yeah, awesome. This is designed to be relevant wherever you are in the world. And as we go through, we've got a few different resources to point you to when you do get to want to filling in some of those specifics as well.
Exactly. So whether you're in New Zealand, like Al and Marie, or whether you're in America, like Monique and Bob, or whether you're in the UK, like us, we're in Brazil, but you know what I mean. It'll work for you there. Okay, so that is the philosophy section. The reason for putting this is so that if things get weird, if the market goes crazy, if your Uber driver gives you a stock tip, then you need to check this document and go, what's my actual plan? And then stick with the plan. Because you don't want to be changing this plan based on what someone wrote in the news, what someone's stock pick gave you a tip down the pub. This is like the thing you always come back to. And if your partner or your friend or your family chases squirrels like Bob, when they come to you with the idea, you say, shall we review the investor policy statement together and see whether we should do that? And that keeps you nice and safe.
Yes.
As a team, always.
We're like solidifying, formalizing what the decisions that you've made through doing Rebel Finance School when it comes to your investing, so that you have that written down to refer back to.
Exactly. Excellent. Right. So that's the philosophy section. So we've done the philosophy section. So we've done goals, we've done philosophy, and now we are going to move on to asset allocation. Asset allocation, Katie.
So again, we split this between whether you're a freedom fund builder or you're financially free. So if you're a freedom fund builder, I'm going to take it back to looking at the net worth split that we talked about back in week 2 of Rebel Finance School. So if you remember, there were the different elements of net worth, which was valuable liabilities. Normally that would be the home you live in if you own it, your freedom fund, and then cash and planned spending. So when we're talking about your asset allocation, we are just talking about what is in your freedom fund. So the investor policy statement is saying, how am I investing my freedom fund? Your cash and planned spending is something separate. So that's your emergency fund, that's your planned short, medium spending, just to make that distinction. So when we're talking about your asset allocation, We're talking about what are you doing with your freedom fund? We're saying, okay, we got the emergency fund sorted elsewhere, short, medium, sinking fund spending, saving for a holiday, a vacation, you're saving up for a new car, whatever it is. We're just trying to make that distinction here. So we're looking at what are you doing with your freedom fund?
Exactly. So if you're a freedom fund, like you're building it, then maybe you actually want, I'm just 100% in a global index fund. This is the time to get specific. It's like, okay, I'm 100% in the FTSE Global All Cap Index Fund, or I've picked this one index fund. And the simpler, the easier it is to follow with time.
And actually, this might be a target. Let's ask Bob about this. So let's quit out and ask Bob. So what does it mean then that, Bob, so why would that be a target? Why is that not what I'm actually doing necessarily?
Yes. Yeah, great question. So this is your idealized asset allocation. So for example, everyone here today, if they're building and they are on board with the Rebel Finance School philosophy, which is just go 100% equities until you get there, you can go ahead and list that in your investor policy statement. However, when you go to actually operationalize it, you might find that some of your accounts are very easy to make that change with no taxable implications. So all of your tax sheltered money would be in that bucket that you could automatically switch with a click of the button and have no tax implications. But if you have something like a taxable brokerage account and you've bought many different funds that are not what your target is, you might not want to sell all those immediately because of the tax implications of doing that. So for example, Amy and I are still, after 7 years now of finding the simple path to wealth and knowing that we're just going to be, VTSAX and chill essentially, we still own things that we quote unquote don't want to own just because we don't want to pay the taxes. They're not that bad that we definitely want to sell them today. So we just slowly unwind them over time in our taxable brokerage account, whilst in our retirement accounts, we go immediately to, hey, this is exactly what we want to own.
I love that. So if you have legacy investments, things you invested in, like individual shares or stuff before you really understood this bit, sometimes it takes a bit of time to unwind out of those and to be able to change.
And the other reason might be that, with your employer, your workplace pensions, you're going to want like as close as you can get to with that. Maybe they don't have that specific fund, but it's just to say, okay, I'm targeting that or as close to that as I can get with the philosophy of a broad-based, low-cost global index fund. Yeah, and Mark and Martin, thanks for putting in the chat. So taxable brokerage account is the same as a general investment account in the UK. We have very generous allowances with ISA and SIP, so a lot of people won't ever need to use a general account, but maybe you will because you might have a lump sum come through from inheritance or selling a home or stuff like that.
Exactly. So if we go back to where we're going with this for this part of the investor policy statement, sort of part one, you've got the specific funds, what you're actually going to invest in. Part two might be, I always take the free money. I'm going to prioritize putting money in my workplace pension first. I'm going to take the free money by using tax efficient accounts. That's where I'm going to focus first. And then maybe you have a little bit, if you're approaching retirement, of I'm targeting X percentage in my accessible accounts, and that's my bridge to get to my SIP. That's my bridge to get my pension, building on what we did on Monday with John. And Monday.
Monday. I was just going to clarify what Monday was in case people watching on catch up and hadn't come on Monday. So Monday, we did a UK specific drawdown session where we covered bunch of stuff, including how to bridge, how to get to those that are aged later.
Exactly. It was super quick and simple at 2 hours, 20 minutes. So there is the UK bridging calculator, which you can use.
Looks like maybe Alan and Katie's internet dropped out. So the UK bridging calculator is a really cool tool that you guys can use, accessible via that QR code there for UK figuring out what percentage of money you need to take out of various accounts that you have in order to bridge you to getting to your retirement. So it would be really cool if there was something similar for the US. There are a ton of tools out there, but I don't know of one that does exactly what this does. There are some very big retirement planning tools that Amy and I have used, like New Retirement or Bolden, that kind of help you figure this out. It's a pretty big topic, though, for once we get to like withdrawal and drawdown strategies. Let's see if I can take control of the presentation. I don't know if I can. Let's see. Okay, let's see here. All right. Can you guys see my screen? Is the UK, just give me a thumbs up if you can see the
Yeah, we can see it, Bob.
Okay, yep. Perfect. All right, so then we have a bit of a different story for those that are already financially free. And I do love this picture of ostensibly Alan and Katie here, because not only is Katie eating pizza and Alan's building Legos, but I love the fact that Katie's fresh off of playing video games with her Atari t-shirt on there. I think that's pretty cool. And we talk about asset allocation by, I used to say risk tolerance, but it really is, in the Rebel Finance School nomenclature, volatility tolerance. And, you know, Amy and I like to ask each other this question whenever we're making decisions about something, which is like, what am I optimizing for, right? And once you've reached your goal of becoming financially free, if you decide to retire early, for example, like Amy and I did, you have something called sequence of returns risk. And you want to make sure that you can have either a high tolerance, a medium tolerance, or a low tolerance for, you know, that volatility in the market when you're retired. And it's a bit different, I think, than when you are in your freedom fund building phase, because as I mentioned before, let's just say you're targeting, you know, retirement in maybe, you know, 10 years or 15 years. If the market goes down and you have to work another year or two, let's say, to get there, it's not a big deal. But if you're living off your freedom fund and the market drops, say, you know, 30% or 40%, that may, you know, cause some concern as far as your spending goes. So once you're financially free, a lot of folks decide to either back off from that 100% global index fund where they might have had a high tolerance during their freedom fund building phase, and back off to like the medium tolerance. This is what Amy and I have decided to do, where we effectively have 80% of our money in that global index fund and then 20% in a bond fund. So this helps to kind of hedge against the volatility, and also just helps us sleep better at night, knowing that we're not 100% equities and we're not subject to the equity volatility that is associated with stocks and shares. And then, ironically, I really like the low tolerance picture. I feel like that's me, the pineapple just kind of like chillaxing there. This would be most traditional retirees in the US. That is like a 60% global index fund and a 40% bond fund. That is what most financial advisors kind of advise traditional retirees to do. So my parents, for example, that retired at a traditional retirement age, their financial professional they're working with would say, yeah, you should go to a 60-40. And that's super, super conservative, especially for those of you that are, you know, in the Rebel Finance School philosophy. So probably the best thing to do is, if you're going to drop back to something like the medium tolerance once you're financially free. Oh, it looks like Alan and you're back. Hello.
Hello. Thanks for taking over, Bob.
Oh, of course. I just kind kind of finished the volatility tolerance slide for financially free. Should I stop sharing and you guys want to share, or?
Yeah, that sounds great. Unless you want to be in charge.
Oh, no, I'll stop. There we go.
I love it. So thank you very much for Bob taking over whilst we had a few Wi-Fi issues here in Brazil.
Quite calm, I think.
We did. No one swore at anyone.
Not in the Donegan household.
Yeah. So people are like, Bob was doing great. And I was like, Bob's doing great.
To pipe down,
we should just let Bob run it.
Yeah.
We'll just put Bob in charge.
Bob, he's just lovely, isn't he?
And he's so calm because he just went like, I'll run it then. So please give a round of applause to Bob for just taking over and nailing it. We love you, Bob.
In other words, like taking control rather than taking over. Taking over makes it sound like he's like a hostile.
No, I like it when people take control. So volatility training, we did want to talk about this. It's what we wrote with Andy. It's part of the Rebel Finance School this year. And quite often what happens is financial advisors will ask you your volatility or risk tolerance and then change what you're invested in based on the way you think. What we always say is don't change your investments, change the way you think. That's the best way to do it. So go back to volatility training if it ever worries you and have a go with that.
Link in the description, and we've put it in the chat if you're watching live.
Exactly.
Bob, did you already talk about your 80-20 split?
Yes.
Cool.
Perfect. Okay, so we are going to move on. If you're financially free, then this is your like freedom fund asset split. It might be your specific funds and your sequence of returns risk strategies. So if you've chosen to go 100% stocks and shares, then this is where you go, I'm going to stick with stocks and shares, a global index fund, but I'm going to use these sequence of returns risks when I need to.
The
strategies for mitigation, such as flexible spending, flexible earning, flexible retirement dates. There's a lot of flexibility here.
I love it.
Or this specific bit of your allocation.
And we are going quite quickly through this bit because this was what we did on week 10 of Rebel Finance School. If you haven't watched that or you want a refresher, go back and watch that because we go through all of this in detail.
So now it's kind of over to you to fill out this section. So for the builders, it might be something like, I've chosen my exact index fund. I will take free money from my employer. I will take free money by using my tax efficient accounts up, and I'm targeting like X% in my accessible accounts.
So that might be, I am targeting 25% in my ISA if you're in the UK, and you've got that bridging calculator to help you work out what that split might be.
If you are financially free, you might have, okay, am I using bonds? If so, what's my split between stocks and shares and bonds? And are there any additional sequence of returns risk tools that I'm using?
And that example that we've given there with the 80-20, those are two funds you can invest in the US. So this is a US example for our international listeners.
And if you decided not to go with bonds, you might put like, here's the exact fund I've gone into and what are my sequence of returns risk strategies to have like protect me should I need it.
Yeah, so maybe you put something there like, I will be flexible with my spending. I'm willing to go back to get a part-time job to earn a few £1,000, dollars a month, a year, whatever it is. Like, what are you going to do if you need to?
So it's over to you now. Please fill out this section of the tool. We want to know, please put it in the chat and tell us, what have you put in there? If you've done it, are you ready? Are you still with us? Would you prefer Bob to run the rest of the workshop than me? Like, tell us your thoughts, write it in the chat, and please fill out this section now. I think you've got to relaunch the YouTube stuff so that we can see those comments coming in from YouTube. And please do ask us the questions as well, if you have any questions for Bob as we're going through this, because that's the whole point of having Bob with us, is to answer those questions and work through it. This has been a fun process so far. Fireman69 says his is be super flexible like a yoga teacher, like a ninja yoga teacher. Fidget says, any advice on using the bridging calculator considering semi-retirement? Fidget, I would say, like, that's Monday's session. Did you come to Monday's session? Did you see that? Please watch that one, because we did a lot on bridging during that session.
And as well, we're going to do the forecasting session on Monday, the next bonus session, which is going to answer some of these bits where it's not quite as straightforward as that binary on-off between working towards being financially free and being financially free.
Exactly. Al says he has filled in the form and he's done it and he's still alive.
Good egg, isn't he?
John's done it. Fidget says thank you, so I'm glad about that. Could you scroll down the comments here for me, Katie? Thank you. Okay, excellent. Everyone's live. We seem to be doing well, Bob.
I mean, we've got survivorship bias. You say everyone's still alive, but I mean, the dead people are just carrying on investing in simple global index funds and doing better than the rest of us alive folks.
Yeah, maybe that's what you should put in this section. I will invest like a dead person. That is my strategy. Mark says, can zombies still invest? Yes, they can, Mark. Yes. Everyone can.
Yeah, we don't discriminate here at Rebel Finance School.
Okay, I think people are saying they're good to go. So we're all good. Everyone seems okay. Love it. Okay, so let's move on to the next section. So we have done goals, we've done philosophy, and now we have just finished asset allocation. This next section is going to be a super quick one. It's drawdown. And basically, if you imagine a timeline of you from your age to your expiration, you don't really need to figure out drawdown if you're 35. Like, you're a long way off retirement.
Well, until retirement age. Like, if they're going to retire at 40, perhaps they do need to.
Maybe they do. So to make that simple, we go, if you are 2 to 3 years off retirement, max 5, then think about having something in this drawdown section. If you're a long way off retirement, then like you don't really need to think about it too much at the moment. For the Freedom Fund builders, what we thought was for this section, you can kind of ignore it, but just put in there, I'm going to start thinking about drawdown when I'm 3 years out or 4 years out, or like set yourself a date for when you're actually going to think about that stuff. Drawdown is a massive subject. We're not covering it today. Monday's session with John Buston was phenomenal, and it is a massive subject. So that session was like 2 hours, 20 minutes, and we will be doing some notes to make it a lot easier. Like, just this is where you put your plan for that section. This was the workshop we did with John, and we have more resources coming. That was
a UK specific session. The link is in the chat or in the YouTube description.
Exactly. Perfect. Bob, tell us about these two resources for our American cousins.
Yeah, so Rob Berger is a really excellent, his field is actually a lawyer, but I really like the way that he thinks about finances in general. He used to have a podcast called the Dough Roller Money Podcast. He sold that blog and his podcast, and he started a YouTube channel. And he creates a lot of really excellent content and a lot of meta content. Like, he tells you how to think about answering the questions. He doesn't answer the questions directly. So he's come up with 7 rules of how to think about retirement withdrawal strategies. And so I think that's a really excellent resource. It's about a 30-minute video that I think will give you the mental model or the framework to help you figure out what you need to figure out and how you should think about it when you're looking to put together your withdrawal strategy. There are so many unique things just in the US, so certainly once we look globally, but I think the way that he gives you the framework is really interesting, and it makes sure that you're going to have all of the things that you need to think about when you're developing your strategy. And then Vanguard has a really good high-level article of the types of strategies that are available in the US. There's certainly more comprehensive resources out there, but these are really 2 great resources to kind of get you started on putting together your own drawdown strategy.
Fantastic. Thank you, Bob. And then obviously we also wanted to include the fabulous people in New Zealand, Earl Hanley, Marie, and all the other New Zealanders. So we messaged Ruth, the Happy Saver from New Zealand, and she sent us an article to start you off. So it's not specifically drawdown, but it's like starting to go, how much money do you need to have invested and how do you use it? So that will start you on the path if you're in New Zealand, and Ruth is a fantastic blog. So that was a very quick section. It's over to you. If you're a Freedom Fund builder, just decide on the date that you'll start looking at the strategy. And if you are financially free, then this is your homework to fill out this section. And just to say, like, Katie and I retired without really knowing how to do this. Don't tell anyone. But you can kind of figure this out on your way. And John Buston always had this thing of like, lots of people in the FIRE world just kind of wing it and figure it out as you go, which is why we kind of keep repeating precision is not required. Sometimes you just need to like go for it. Thinking is very useful and you do need to figure it out. But we also wanted to take a little bit of the stress and pressure away from this stuff.
I think you could, you know, if you did come to that session with John that we did, Drawdown Demystified, perhaps you put in here a couple of the things that you learned from there at a high level, if that's where you're currently, you know, if this is new to you and you're just figuring it out, or if it's, if you have done a little bit more thinking on this and you do have more of a plan, you could fill this in here as well.
Love that. Some comments from YouTube. SRF says, Bob is brilliant. Mark says the picture of pizza is making me hungry. Me too. And Hurston says, what does Bob do for drawdown? Which we are going to come on to in the next section, which is super exciting. And then Ruth says, don't let perfect be the enemy of good. Great. Exactly. We just need to make progress on this stuff. So that was just a very brief, this is where you put drawdown in your investor policy statement. So once you've thought about it, that's the section it goes in. So that's drawdown. And we're going to move on to rebalancing.
So for Freedom Fund builders, if you're following the Rebel Finance School philosophy, you're probably going to be 100% in stocks and shares. Equities, just another word for stocks and shares. So this is irrelevant to you because like you don't, like, what are you going to rebalance from and to? It means rebalancing between different asset types. You don't have different asset types. So actually you could just put here that you're going to decide by X date whether you are going to rebalance when you do get to closer to being financially free.
However, if you are financially free, this is relevant. Actually, even if you're 100% equities, which Katie and I learned recently. Why? Because you do actually need some cash to live off. Money to live off is good. You need money to buy pizza and food and do whatever it is that you want to do with your life. And Bob has this amazing mental trick, which he actually taught us at the economy conference last year. And I was like, Bob, this is really smart. I've never heard this before. I need you to tell the Rebel Finance School audience. So this is the bit everyone's been waiting for. Bob, tell us your mental trick.
My mental trick is when you save and invest all of your life and you've built your freedom fund, once you get to the point where you retire early, it is not something that is, it's intellectually easy, but emotionally difficult to go into Vanguard and actually hit the sell button, right? You feel like you're doing the wrong thing because you're always buying, you're never selling. So instead of thinking about our drawdown or withdrawal strategy as a drawdown and withdrawal strategy, we just simply think of it as an asset allocation strategy. So we've added in, I told everyone already, we have an 80-20 allocation, 80% equities, 20% bonds. But what we've done is we've actually taken our cash allocation and brought it into the investor policy statement. So we, instead of saying 80-20, we say we're 80, 17, and 3. So 17% bonds and 3% cash. And then, of course, we just live on that cash, just as if we were still getting paychecks. And every month when we do our financial meeting and we look at our accounts, we look and see if we're still at that 3% mark And if we're below it by a significant enough amount, say once we get down to like 2.5%, we will reallocate from either bonds or equities to cash. So our drawdown or withdrawal strategy becomes just an asset allocation strategy. We're keeping that cash bucket topped up at about 3%. And it makes it's a mental accounting trick to make us feel like we're not drawing down, we're not withdrawing, we're just keeping a constant asset allocation of 80% equities, 17% bonds, and 3% cash.
I love that, because Katie and I had an experience last month where I booked a lot of our travel for the rest of the year, and I basically spent all our cash. And then I was like, oh, shoot, we don't really have any cash. What am I going to use? I've got big bills coming.
How are you going to pay for your pizza?
I know. So we had to like sell off some stuff quick and do some things. Like, we had plenty of resources, but resources versus cash are two different things. So actually, like, Bob having taught us this and reinforced it, we've made a decision over the last month to make sure that we always have enough cash on hand to be able to pay for our lives and what we want to do. And this is a super simple way of doing it. One clarity piece that needs doing, Monique says, so you're following a 3% rule, not a 4% rule, Bob. How is this different from the 4% rule? Because, like, it's a different thing, isn't it?
Yeah, it's an interesting question. And this is more, earlier in the presentation, I said, Amy and I like to always ask each other the question, like, what are we optimizing for? And Amy and I have always been kind of very conservative in terms of how much cash that we wanted to keep on hand. So this was just a personal decision that we made as far as what would make us sleep well at night, having X% cash. Now, of course, we're doing it as a percentage. We could just do it as a dollar value as well. Like, say we need to have at least 50K in cash or 100K in cash, whatever that value is. We just chose 3%. It is to the point about the safe withdrawal rate. We don't use the 4% rule necessarily, nor do we spend exactly 3%. We actually we've been spending about 3.5-ish% per year. So it's correlated, but it's not, we're not saying we want to have a year's worth of spending. We just feel good with about 3% in cash on any given basis. And then there's exceptions to this as well. We're currently doing a very big renovation project on our house. And like, when we made the decision to do the renovation project, we actually immediately, like the day we made the decision, said, okay, we're going to allocate that to cash today. So like, that's a special, big picture spending thing that's over and above, like, we feel comfortable having 3% in cash. So yeah, great question.
Awesome.
Can I give an example to help explain why they're different things? So if you say, like with Bob, he's decided, like, I want to have 3% cash in my bank account, in my checking account, my current account. You could argue, like, okay, I'll put my 3% in and spend it all immediately, excuse me. And then you'd need to, like, take another 3% out. So it's not like we're saying that's what you're spending overall. It's just saying how much you're having in kind of your cash in your little slush fund that you're actually spending. We're not saying that your percentage of your net worth, as opposed to what you're drawing down every year. I have a little diagram that might help as well.
We do. Just before you do that, Westermo Lad on YouTube says, this is all like a Jedi mind trick. These are not the equities you're looking for, which I think is fantastic. And you just rebalance the cash and use it. And then someone said, where do you put the cash? You have yours in a money market account, your cash, as I understand.
Yeah, so Amy and I have, it's interesting. We have an amount, so over and above just the 3%, we have an amount that we like to keep in our checking accounts. So that's about 40 to 50 grand we like to keep in our checking account. Again, just because we optimize for sleeping well at night. We're not spending that on a daily basis. That's just what we like. We feel like we like to have that in our account. So anything over and above that is part of the 3% cash, we keep that in our Schwab brokerage account in a money market fund, a Schwab money market fund. So at any given time, if I need to move money, I can sell the money market fund, and then very next day I can move the cash. So it takes 2 days to access the money in my money market. And of course, what's in my checking account, I can access immediately on any day.
And a checking account in the US is what we call in the UK a current account, just the account where you operating day to day that has your cash in that you're spending.
It's almost like we speak the same language, Bob.
Really?
So, Katie, you had a little graphic for the mental trick here.
Yeah, so this again is a visualization. If you did week 2 of Rebel Finance School, you'll be familiar with this split, that this is your total net worth. So you've got your freedom fund, which I've shown as that big yellow box because we're talking about when you're financially free. So it's going to be a big chunky amount of your net worth. And then you can see there you've got valuable liabilities. That's normally your home. And then cash and planned spending in that bottom corner. So this idea is what we're doing here is we're helping with that mindset switch from building your freedom fund, always buying these assets, buying these equities, to hang on, now I'm going to have to switch to selling. And you're selling those units to have the cash to live off. So we're just moving money from the freedom fund into the cash to be able to spend it. And Bob came up with this genius mental trick to help him and help a lot of us who might have problems with moving from always accumulating to then spending and using the freedom fund. He came up with this little trick to say, okay, how can I trick myself into being okay with putting moving funds from my freedom fund into my cash?
Yes.
From the yellow big box to that green one.
Elizabeth says, love the mental trick. And yes, decision making, allocating cash ahead so funding is in the right place for any project or monitor monthly, particularly in later life retirement where habits can die hard, which I love. Kate says, where do the Donegans keep their cash? Is that also in a current account?
Yes.
We keep it in a savings account.
Really?
No, mine's in a current account.
Yeah,
we just keep it in the current
suboptimal
account.
We're not getting any interest on it.
So there you go, suboptimal Donegan decision. But there are different ways of doing it. Bob has his 80% index funds, 17% bonds, and 3% cash. You might have an all stocks, and then you pick like a split between stocks and shares and cash, which I think is what we're going to do to make sure that we have a bit more cash on hand and no squeaky bum moments when you're trying to pay for your next hotel.
Or maybe you have a monetary amount that you're happy with, and will be different for different people. Maybe you always want to have at least 10 grand in your current account. That's the UK term for a checking account. Maybe it's 2 grand, maybe it's 5 grand. It will be different for different people. So these are the different ways of thinking about it. So then coming back to this mental trick, so we're ignoring that valuable liabilities part because that's your home. That's not really part of what we're talking about here. And then maybe you put in, you see that came up here, they'll put example 97% in your freedom fund, and then maybe it's 3% in your cash, or 10 grand or 5 grand or whatever it is, whatever would make you feel comfortable that you had cash to operate in your life.
Exactly. And the whole point is just periodic rebalancing.
Yeah.
Your freedom fund split might get out of whack because you spend the cash, because your stocks and shares grow. It's kind of irrelevant on the journey because your freedom fund is 100% equities. But when you're getting there or thereabout, this is an important part. And it's that like big picture rebalancing.
So there's 2 things here. So the mental trick is about getting money out of your freedom fund into your cash so that you can spend it. And then this big picture rebalancing is about saying, actually, Bob decided, for example, that he wanted 80 equity, 20% bonds. So then there's some big picture rebalancing to make sure that if you choose to keep that allocation, to have that consistent over time.
Yes. And precision is not required. You just need to decide on the numbers and then go for it. We had a bit on big picture rebalancing. You kind of have 2 decisions to make. First is how often, annually, quarterly, that stuff. And then second is when do you do it? And you can pick a date, meaningful or otherwise. Bob, what was your answer on those 2 questions? How often and when do you do it?
We chose to do annual big picture rebalancing, and I chose Amy's birthday, mainly because J.L. Collins told me that he does Jane's birthday as his rebalancing. So I'm like, well, if Jane's birthday is good enough for J.L., then Amy's birthday is good enough for me. So we just do it once a year. I've read that some people do it quarterly. I think most of the research out there shows that as long as you do it, you'll be in good shape. It doesn't make much of a difference whether you do it quarterly or annually. So I think for the effort, doing it annually for big pictures, that seems to make the most sense. It's working well for us so far.
Are there any dates you would avoid doing this on?
Yeah, I tend to tell my third decade participants to just avoid doing like the first or last day of the month, let's say, or like certainly the last day of the calendar year, like or the last day of the last trading day of the calendar year. There's a lot of weird stuff that could potentially happen at those times when fund managers are trying to either dump something out of their portfolio or try to juice the returns, what have you. They're typically lightly traded days, and you might have some extra volatility on those days. So I would just say pick something other than that.
Love it. And Bill from Catching Up to Fi in the chat backed you up and said it can be best to choose a date that is mid-quarter or mid-year and avoid the first quarter or last quarter just because of that, exactly what Bob said. So this is now over to you to fill out the last section of this piece of work. So you are closing in on having your investor policy statement done.
So for builders, this bit is irrelevant until, if you're going to use bonds when you're financially free, you're going to want to think about the big picture rebalancing 2 to 3 years when you're coming up to that. Because, if you're choosing to switch to some bonds, you're going to want to be doing that rebalancing.
Exactly. If you're 100% equities, well, then you can just figure out the mental trick when you get nearer there.
Yeah, because remember, we're thinking about two different things here. One is this mental trick to make sure you've got some cash to spend, and 2 is maintaining that overall asset allocation. So when you are financially free, thinking about this mental trick, you can put in your investor policy statement, I keep X% in cash, or that monetary amount in cash, whatever feels comfortable to you.
And if you're using bonds, you can say, I rebalance my Freedom Fund annually on Jeff's birthday. I don't know who Jeff is, but, just pick some person. You could pick Derek's birthday. I rebalance my fund. How else do you celebrate someone you love than rebalancing your portfolio on their birthday? I don't know how else you would do it.
And that's the periodic, that big picture rebalancing that we're talking about. So remember, there's the mental trick. That's I keep X% in cash or a certain amount, monetary amount in cash. That's that mental trick to make sure you can live your life and enjoy it and have cash. And then you've got that big picture rebalancing. So those are the 2 elements to think about.
So please finalize your investor policy statement right now and write that last segment in, press submit, and then the Rebel Finance School Ninja Pixies and Unicorns will create you a PDF and email it back to you instantly. No, we don't use software. We use Pixies to make this happen in the background. Jack on YouTube has said, when's Derek's birthday, so that I can put it in my policy statement.
Derek also says you could rebalance by putting the cash in his bank account as well.
I love that, Derek. Yes, if you could give us your bank account details right now, we will make sure that happens.
So Leia's saying, is rebalancing withdrawing from your Freedom Fund? Is that what we're talking about here?
Well, that's kind of how Bob has been using it. And there's the 2 elements. Bob's using it to make sure he has enough cash on hand to live, and then the bigger picture rebalancing to make sure you're split between those 2 assets annually. So that's the bigger picture bit. Westermolad on YouTube says we should have an RFS rebalancing day. So we all choose to do it together and we have a big rebalancing party. I actually quite like that idea. Yeah, so there we go. Please tell me that you've done this. Put it in the chat. Put D for done. Put, I don't know, another letter for not done.
C for confused.
Oh, KK puts like triple Ds. Done. There's a lot of people who are like, I've done this.
We've got a C from Amanda. Tell us how we can help Amanda. Amanda put a C for confused.
Ella put, I'm doing it later. Andrea says, I've even got my statement in her emails. I love that.
Katrina, same, nice.
Yeah.
I'm glad the Pixies are doing their jobs.
Because when you think about this, like what percentage of the world has a personal investor policy statement? Like you are in a very minor, small group of people who've actually thought about your investment strategy, written it down, and actually working on it. Like it's absolutely incredible what you've done today. Please give yourselves a round of applause or a pat on the back, or like if you're Wes and Kim, just hug each other because you're there. You know, you can hug someone. Oh, look at that. They're hugging. It made me very happy. Round of applause, hug, pat on the back. Like you've done something that so many people like don't even know exists, which is just incredible.
Amanda is confused because she missed the first 15 minutes. So I encourage you. That makes sense. Like,
that makes sense.
It's like, what is an investor policy statement? So this is available on Catch Up. Please go and watch it and watch those first bits that you missed, because that was some useful setup to understand what on earth we're going on about.
It is. Fireman on YouTube says this is definitely not a cult, right? Yes, we're rebanding. It's a club, not a cult. Please repeat after me. This is a club, not a cult. This is a club, not a cult. Mark, I can see you saying it the other way round. Don't be naughty. Okay. Steve says he's going to do his on Catch Up, which is fantastic. Derek says my birthday is next month, so stand by for rebalancing. And Mark says I'd like to join a pizza cult, which I think is someone else's platform. Right. Let's move on to the next little bit here. So you have come a huge amount of distance in a very quick time, bringing together everything for Rebel Finance Course. We've looked at goals, philosophy, asset allocation, drawdown, and rebalancing. And congratulations, like you've done it. You've got your first ever investor policy statement. Refer to it often. Maybe look at it at the monthly finance meeting, your annual finance meeting. Look at it often. It is your document for what to do when
the market crashes, when the market recovers, when the experts say this time is different, and when the market seems cheap or expensive or whatever happens, whatever anyone is saying, and you're thinking of changing how you invest. This is your rock. This is your anchor. This is to refer back to.
Okay, so then we go like, when should we change our investor policy statement? So this is the interactive section, everyone. I want your answers now. Should you change your investor policy statement if you see an article that says index funds will no longer be successful in the future? Wes is nodding. Please, Kim, slap Wes right now. The next time, yes, Katrina says no. Heather says yes.
Kim.
Sorry, someone should be told off. I don't know who it is, but someone should be told off.
We're getting lots of no's.
Okay, lots of no's, good.
And a 9.
A 9, there's a German no. Should you change your investor policy statement if you're feeling nervous?
Got some no's.
No's, okay. Should you change your investor policy statement if there is a new meme stock that you could invest in? Should you change your investor policy statement if you've read something on social media that says you should do? Okay, good. Mark says I'm laminating mine so I can't change it. That's awesome. Yeah, and the other Mark says this is the whole point of having one, to not overreact. Exactly. Bill says only change after careful consideration and a 3-month sleep on it clause, which I really quite like that. You could put a clause, I will have a 3-month sleep on it clause, and then maybe not. But we just wanted to make really clear there are some reasons that you would change it, but there are a lot of reasons why you wouldn't change it. So when should you change your investor policy statement? Well, like, yes, if you're changing from building your fund to being financially free, you might add to it. You might change it if you've become financially free. You might change it if you have major life changes, like you've moved country or your goals change, or you've got married, or your partner expired or something changed. You might change it. and you might rework it, or you've achieved your goals or your goals changed. But in 99% of instances, there is a heck no, I will not change it.
To things like something's happened in the stock market, or there's a new fad, or everyone's talking about the latest meme stock. Someone said something that scared you on the news, you read something on social media, and all those hot stock tips from your Uber driver are not reasons to change your investor policy statement.
Exactly. So you just kind of like ignore the news and stick with it. And the whole point of the investor policy statement is to keep you safe when the world is crazy around you. Now, we obviously have a little bit of freedom work for you. If you're financially free or approaching, your job is to work on your drawdown strategy. That's actually Katie and I's homework as well after John's session on drawdown strategy. Second, review your IPS in your monthly finance meeting, your annual meeting. Like, actually, have you got it? Like, use it. And three, put it front and center somewhere, maybe on your fridge, inside your wardrobe, on your home screen, your bathroom mirror, pin it to Derek. I don't know, whatever you do, like have it somewhere you will see it regularly. It's very important. Now, we've got a little closing message coming soon, but before that, it's been a busy time at Rebel Finance School. We had the first bonus session, How to Live Off Your Money in Retirement with John Tick. We've had the bonus session with Bob about the rules of investing in investor policy statements. On Monday, we have Katie's financial forecasting spreadsheet for you. This is what the Mad Scientist taught us to do, and it completely changed our lives, this spreadsheet. So we're very excited to share it with you.
Yeah, this is a version 2 of the workshop that we did 3 years ago and got a lot of positive feedback. So we're doing a refresh and improvement to bring to you for this year.
Exactly. Then we have a question and answer to wrap up all of your questions about Rebel Finance School, so you can use the form to stick those in. We have a Monday session with the fabulous Doc G from the Earn and Invest podcast, where he's going to talk to us about purpose. And then finally, you get to ask us all the questions you've been dying to ask us, like where do you keep your Lego and why do you keep going on about pizza? So we have a final Q&A, and actually it's just an excuse for us all to hang out and chat about it. It's going to be great fun.
So 2 ways to watch these workshops, bonus sessions. Firstly, if you are watching in real time or there or thereabouts, please come live if you can, and scan that QR code on the left. That is got all of our events on it. If you're watching this after the fact, you can find it all on our YouTube playlist, which is on the right-hand side. Both of these descriptions are in the YouTube. Both of these links are in the YouTube description.
Exactly. If you've got questions for the 2 questions coming up, then you can submit them beforehand so that we can prepare, which would be very useful. This is the question form, and you just kind of click the drop-down box and you can put my questions about Rebel Finance School, or my question is for the Ask the Donegans Anything bit.
Which is a new thing that I put on the form so that we can just see those questions on their own if you had a question for us.
KK says we've lost sound. Can you someone nod to tell me you can hear me?
Oh,
okay, people can hear me. Excellent. KK, I'm afraid it's you. I'm sorry.
Sorry, KK.
We love you. Okay, so we've got that coming on. And then there's so much going on, isn't there? The closing message today. Number one, Bob has given up his time to help us create the policy statement, create the tool, write the blog article, and then run the workshop. He also took over when the Donegans went dark. So please give a huge round of applause to Mr. Bob Messi.
Lionel Haines.
Lionel Haines, there he is. Messi Bob. We love him.
A few people have asked Bob how they can hear more from you. Do you have some kind that people can follow you either in a stalkerish way or online, or you don't really, do you, to my knowledge?
I don't really. I'm planning on posting a bit more content on my Instagram, but that is all photography related. So I'm at RJ Haines on Instagram. So, if you're interested in nature and landscape photography, that's something that I do there. But yeah, I don't have much of an online presence these days. So it's kind of nice being. I was very online in my career, So for the past 6 years, I've kind of just wanted to move away from that. So
I love that. Well, Bob, you are always welcome. Whenever you have something to share with people about financial independence, you are welcome back to our platform to share your messages, because we love that you shared what you've been doing, and we really appreciate you.
thank you. I've very much enjoyed this. So thank you for inviting me.
That's awesome. And do check out Bob's pictures. You will see regular pictures of him and his dad holding the biggest fishes you have ever seen in your life, because Bob fishes in retirement with his dad, and he takes pictures of sunsets and does all the things that you should be doing. And he is just awesome. So the final message from Katie and I is the investor policy statement is the thing that keeps you safe when the world goes crazy. This is the thing that you go to when you go, my partner says we should go all in on crypto. And you go, let's go back to the investor policy statement, shall we? And have a look at what it says. And you stick with the plan. We invest like a dead person, and we just keep going with our plan in the future. Even when things are going crazy, when politicians do crazy things, when the world is going crazy, we will be calm, cool, and collected, just like Bob. And that's it. That's the end of tonight's workshop. It has been fantastically fun.
I think SRF's got a crush on Bob. Says you got a gorgeous smile, Bob.
Yep, I totally agree. Bob is lovely. There was a couple of questions in YouTube here, Katie, that I did want to just go up slightly more. Okay, there was a lot of clapping hands. That was the question. Have you seen people downsize or release equity from a property, or sell it and move to Brazil like you two, in order to top up the Freedom Fund to the required amount? Yes, we have. There are 2 rebel ninjas that sold their house and have moved onto a boat and become financially free. And there's lots of situations where people have done this, sold a property, invested the money, and that's enough then to live on for the rest of their life. So it is a strategy lots of people have used. We didn't necessarily sell our house to do that.
It was that, yeah. We always thought of our net worth as a separate split. So thinking back to that net worth split that we had, there's the orange valuable liabilities, there's your freedom fund, there's your cash, and then there's also any debt if you have debt. We were always very focused on having our freedom fund be able to cover our living expenses. So we never counted on the valuable liability. We did then later come to sell that as a later decision anyway, and then that did move into our freedom fund. But we didn't, the reason that we were able to become financially independent was separate from that, although people do use that as a tactic to get to financial freedom.
Exactly. And basically we sold our flat because in 2019 we spent 6 months of the year traveling, and we were paying for accommodation whilst traveling and an apartment in Basingstoke. And that didn't make us happy. When we looked at the annual expenses, we're like, why are we paying twice to live? So we just chose which one we wanted, which at that time we were like, we don't want the flat in Basingstoke, we want the travel. Mark on Zoom says, I don't think I'd ever want to sell my house. Mark, you don't have to. You just have to have enough assets to look after yourself, and where you live is completely personal preference. So you should do exactly what makes your heart sing and make you happy. Just know the maths and know the financial cost of your decisions, and then do the decision that's right for you. Perfect. So there we go. YouTubers, thank you for coming. Thank you for being part of this. Take your individual policy statement, your investor policy statement, pin it on the wall, create a new one next year and develop it and improve it. Don't change it, develop it, improve it, and keep working on it. YouTubers, thank you for coming. Good night, YouTube. We love you. Bob, do you want to say good night to YouTube?
Good night, YouTube. Thank you very much for coming. Congratulations on building your own investor policy statement.
It's absolutely amazing. So thanks, YouTube. Good night, YouTube. Okay, I'm pressing end stream right now on YouTube.
Bye.